So let's talk about Archer Aviation. They're one of the big players in that whole electric air taxi game, but lately their stock has been on a wild ride, and mostly in a downward direction. The big question is, right, is this a sign of more trouble, or is this a massive buying opportunity in disguise? Today, we're going to dig into a new technical analysis report to see what the charts are really telling us. Let's get into it. Okay, so first things first, let's just set the scene here. If you look at Archer's stock over the last few months, it's been a total roller coaster. A huge climb, followed by an even more dramatic fall. I mean, think back to mid-October. It wasn't that long ago. The stock was absolutely on fire, hitting a peak of $14.30. The excitement was real, and it felt like the momentum just couldn't be stopped. Okay, now flash forward to today. The picture? Completely different. The stock's sitting at $8.94. That is a huge haircut. We are talking a drop of over 37% from that recent high. Ouch. And this really brings us to the million-dollar question, doesn't it? After a drop this big, where does Archer's stock go from here? Is it time to buckle up for more pain, or is a big bounce right around the corner? Well, to try and answer that, the analysis kicks things off with an overall technical score. And, let's just say the first impression is a little worrying. The report gives Archer a technical score of around 40%, and it slaps a bearish label right on it. This top-line number tells you one thing right away. For now, the bears are definitely in control of this stock. Okay, so let's peel back the onion a bit. Let's look at the primary trend indicators. What signals are pointing so strongly toward this bearish outlook? A key tool for this is something called moving averages. The easiest way to think about them is that they just smooth out all the day-to-day price noise so you can see the real underlying trend. And the rule of thumb is pretty simple. If the current price is below its moving averages, that usually signals a downtrend. And when you look at the data for Archer, wow, it is crystal clear. The current price is sitting way below its key moving averages, over 8% below the 10-day and a whopping 13% below the 50-day. I mean, that's pretty much a textbook confirmation of a downtrend. And it's not just the moving averages, A whole bunch of other trend indicators in this report are all singing the same tune. The message is coming from every angle, loud and clear. Sellers are in the driver's seat, and the path of least resistance has been straight down. But this is where the plot thickens. A strong downtrend is one thing, but is the momentum of that trend starting to run out of gas? Let's go looking for some hidden clues in the momentum data. This slide really captures the whole puzzle in this analysis. See, on one hand, you've got indicators that are still bearish. But on the other hand, you have key indicators like the RSI and stochastic that are in what's called oversold territory. This basically means the stock has been sold off so heavily, so fast, that it might be due for a snapback. The selling might just be overextended. So, here's the crucial takeaway. The report directly says that these oversold conditions signal a potential for a short-term bounce, or at the very least, for the price to stop falling and stabilize. That downward momentum might finally be running out of steam. So we have a downtrend fighting against a potential bounce. So who wins? Well, a lot of times, the tiebreaker is volatility. Before we get too excited about a rebound, we have to understand the risks involved here. A great way to visualize volatility is with Bollinger Bands. Just imagine them as riverbanks for the stock price. When those banks are really far apart, it means the river is wild and unpredictable. In other words, high volatility. And for Archer, that river is definitely wild. Volatility is high, and the wide Bollinger Bands confirm it. But notice this one important detail. The price is currently trading near the lower band. This can actually be another signal that a stock is oversold and due for a bounce back toward the middle of the river. Okay, so let's recap. We have a confirmed downtrend, we have momentum signals that are totally fighting each other, and we have high volatility. How do we put all these pieces together to get a clear verdict? Well, the report boils it all down to two critical price levels. Watching how the stock behaves around these two numbers could be the key to figuring out its next major move. And here they are. It's a fork in the road. The bullish path starts if the stock can decisively break above that resistance level of $8.83. If it does, the next targets are higher up. On the flip side, the bearish story takes over if the stock breaks below its key support at $8.02. A failure there could send the price tumbling to new lows.
And this leads to a very specific recommendation from the analyst. It is not a simple buy or sell. It's a high-risk strategy that actually plays both sides. You could buy the dip near that 802 support level, but with a very tight stop loss. Or you could short a rally if it fails at that 883 resistance. It's a strategy built for a volatile stock like this one.
Now, it is absolutely crucial to remember this is a purely technical analysis. It's about reading the charts, not the company's balance sheet. The report strongly advises that you also review Archer's fundamentals and keep a close eye on the entire EV and aerospace sector because it is a very volatile space. So we end up where we began, but now we have a much clearer picture of the battlefield. You have a strong downtrend clashing head-on with these powerful oversold signals. The lines have been drawn at support and resistance. So the final question remains, which path will Archer stock ultimately take?